AI infrastructure spending is projected to hit $765 billion in 2026 alone and to increase to $1.6 trillion annually by 2031. The biggest infrastructure buildout in modern history is happening right now, and the companies providing every layer of this AI buildout are sitting inside these 6 ETFs that I'll be covering. So let's get straight to it. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. First up is AIPO, the Defiance AI and Power Infrastructure ETF. AIPO tracks the market vector US-listed AI and Power Infrastructure Index. This index holds companies that generate at least 50% of their revenue from one or more of the following sub-themes. First is power generation and electric grid equipment. Second is construction and engineering. Third is electric utilities and power producers. And then fourth is data centers and AI hardware. The index screens companies by some liquidity and size criteria, and then the index splits up the weight of the portfolio across these 4 sub-themes, with 50% weight in the first sub-theme of power generation and electric grid equipment, and then 15% in the second and third sub-themes, and the remaining 20% weight is in the fourth sub-theme, which is data centers and AI hardware. And this index is rebalanced and reconstituted every single quarter. For the fees, AIPO has an expense ratio of 0.69%, costing $69 yearly for every $10,000 invested. The portfolio of AIPO is made up of around 77 stocks, with top holdings in Quanta, GE Vernova, Vertiv, Bloom Energy, Broadcom, and more. It has a big chunk of infrastructure and power companies, which highlights exactly what this fund is built around. Onto the sector exposure, industrials makes up over half, followed by technology and utilities. Unlike many other AI ETFs, this one leans on the industrials and utility backbone of AI. Now, AIPO was created in July 2025, so just short of a year old, but in that time, it's had returns of over 60%, and for a new fund, that's definitely something to pay attention to. Every AI model that's trained and every single data center runs on power, and right now, that power demand is growing faster than the grid can keep up with. And AIPO invests in companies that can help with this problem, like manufacturing grid equipment, transmission lines, power systems, and bringing that energy online. This is an important layer in the AI ecosystem. Since AIPO is wrapped around AI infrastructure, if AI spending were to slow down or data center development stops, this fund is going to feel it. And any supply constraints or inflationary pressure could add another layer of risk to the fund. But AIPO is for those investors that want exposure to the energy and infrastructure backbone of the AI buildout. Coming in at number 2 is soxx, the iShares Semiconductor ETF. This ETF invests in the NYSE Semiconductor Index, which invests in the 30 largest companies in the semiconductor industry. It's made up of US companies across the full semiconductor value chain, from the chip designers to the manufacturers to the equipment makers that build the tools that are used to produce them. And the index has some stock caps in place where the top 5 stocks are capped at 8% weight each, and the rest of the stocks in the portfolio have a cap of 4%. soxx is rebalanced quarterly and reconstituted annually, and it comes with an expense ratio of 0.34%, costing you $34 for every $10,000 invested. For the portfolio, soxx has 30 holdings, with its top holdings in well-known names like Micron, AMD, Intel, Broadcom, and NVIDIA. And on the sector side, it's as pure as you can get, with semiconductors making up around 80% of the fund, and the rest is semiconductor equipment. Now, this fund has been a big performer, where over the last year alone, soxx has had returns of 175%, 5-year annual returns of 27.8%, and annual returns of 33% over the last 10 years. Now, that's some serious growth thanks to one of the fastest growing industries in the market. The power of soxx is that it focuses only on semiconductors. They're the foundation of most electronics, and that spans as far as autonomous vehicles, 5G, defense systems, consumer electronics, and cloud computing. And with the crazy increase in chip demand, the potential runway for this industry is huge. Now, with that being said, only focusing on a single industry means that when semiconductors are on a rough patch, this fund is going to feel 100% of it. And the same thing can be said on the side of positive news and sentiment. But soxx is a benchmark semiconductor ETF that has a pretty long track record, and it could be a solid option for someone that wants broader exposure to the semiconductor industry. Moving on, we have dtcr, the Data Center and Digital Infrastructure ETF. This ETF tracks the Solactive Data Center REITs and Digital Infrastructure Index. And this index invests in companies that generate at least 50% of their revenues from owning, operating, or developing data centers and cellular towers, or manufacturing the servers and or other hardware that's used in data centers or cell towers like semiconductors and processors. And the index has some weight caps in place where the maximum weight of a data center or cell tower company is 12% and is 2% for a server or hardware company. Also, the combined weight of any stocks that are above 4.5% is capped at 45%, and all other stocks are going to be capped at 4.5%. The index is rebalanced and reconstituted twice a year, and it comes with an expense ratio of 0.50%, costing you $50 for every $10,000 invested. DTCR's portfolio currently has 25 holdings in total, with top holdings in Equinix, Digital Realty, American Tower, Crown Castle, and NextDC. On the sector side, real estate makes up the majority at over half, then technology and communication. Now, the real estate exposure might seem surprising, but many of these big data center companies are structured as REITs or real estate investment trusts. For the performance in the last year, DTCR has had returns of 85.5%, while the 3-year annual returns are 32.3%, and the annual returns since it was created in October 2020 are 14.3%. It goes to show in the most recent years how much data center demand has really been accelerating. Global spending on data centers could reach $7 trillion by 2023 to keep pace with compute demand. And that money is going to flow through the companies that you find in this ETF, which are the builders and the operators that are essentially the engine room of AI. And these are the companies that DTCR focuses on. But something to consider is that this fund is highly concentrated, and not just in this part of the industry, but also how much of the portfolio is in a handful of companies and the limited amount of holdings that the fund has. It also has about 25% of international exposure, which could bring in some geopolitical risk. But DTCR is a pure play on the physical infrastructure layer of AI and is for those investors that want exposure to data centers and the physical backbone of AI. This fourth one steps back for a broader view, and that's IGM, the iShares Expanded Tech Sector ETF. This fund tracks the S&P North American Expanded Technology Sector Index, which is made up of US and Canadian tech companies. And the special thing about this tech fund is that it also includes select technology-related communications and consumer discretionary companies. Unlike the other funds on this list, IGM isn't built around a theme or a layer within the AI ecosystem. It's giving exposure to semiconductors, software, hardware, internet services, communication, and more. And this fund is market cap weighted, and it has a stock cap limit in place of 8.5% for individual stocks, so anything above that gets moved into other holdings. The index is also rebalanced quarterly and reconstituted twice a year. IGM has an expense ratio of 0.39%, costing $39 for every $10,000 invested. Getting to the portfolio, IGM currently has 289 holdings, and the top holdings has big names like Broadcom, Apple, Nvidia, Microsoft, Micron, and more. For the sector exposure, semiconductors are up top, then tech hardware, interactive media, and system software. AI is spread all throughout this fund through the chips, software, cloud platforms, and more, which are all pushing to expand in their use and optimization of AI. And the tech sector has been a solid performer, where IGM has had 1-year returns of 60.9%, 5-year annual returns of 17.8%, and annual returns over the last decade of 23.6%. Those are some strong and consistent returns that it's provided over different time horizons. What makes IGM stand out from the rest is the broader exposure without that high concentration risk. IGM is a different approach as you're owning the entire tech sector, which has AI within it. Stocks like Nvidia, Broadcom, Google, Micron, AMD, and others make up a significant portion of the fund, so you're getting solid exposure to AI without depending on a single theme or a layer in the ecosystem. Now, the trade-off is that it won't move as much as a pure play fund when the AI theme is rallying. So if semiconductors or data center stocks take off, IGM will only be able to capture some of that movement. Either way, if you're an investor that wants solid AI exposure without being hyper concentrated in one part of the ecosystem, a broad tech fund like IGM is a good one to consider. Shifting gears, this next one is really unique, and that's Robo, the Robo Global Robotics and Automation ETF. This fund tracks the Robo Global Robotics and Automation Index, which invests in companies that are driving innovations in robotics, automation, and artificial intelligence. The index splits companies into 2 different categories, which are technologies and applications. Technologies are companies that manufacture the machinery, hardware, sensors, and equipment to make the robots work, or the software and processing systems that help the machines become autonomous. The second one, application, are companies that use robotic and automation systems in their product or manufacturing process. The index also has some screening criteria, and it gives a robo score to companies that ranges from 1 to 100, and companies with a score that's higher than 50 are going to be selected for the index. And the index is rebalanced and reconstituted every single quarter. For the fees, robo has an expense ratio of 0.95%, costing $95 for every $10,000 invested, which is pretty high. Now, Robo's portfolio contains 78 stocks, and the top holdings are in companies like Harmonic Drive Systems, Infineon Technologies, Highwind Tech, Delta Electronics, Qualcomm, and more. The top holdings are pretty evenly spread, so there isn't one company that's dominating. For the sector exposure, it's mostly going to fall in industrials and technology. This fund is giving you exposure to the global robotics industry, so it's going to hold companies from all over the world that you might be less familiar with. And you might be thinking this is a new fund, but it's been around for a while. In the last year, it had returns of about 57%. The 3-year annual returns are 15.6%, and the annual returns over the last 10 years is nearly 13%. This fund kind of underperformed in its earlier years, but AI in recent years has really reignited the thesis behind robotics and automation. The real strength in Robo is the part of the AI ecosystem that it owns. Robotics and automation is where AI shifts from just being software to changing physical industries like in manufacturing, healthcare, logistics, and more. And we're in the very early stages of this. Right now, it might be one of the least talked about pieces of AI when it comes to stocks, but it likely will be one of the most impactful over the next decade or so. Now, this fund is one of the most expensive on the list, even though it has some huge potential. And remember, your expense ratio is already included in your total returns. Another thing is that this is a very niche industry in its very early stages. Robo is exposed to the same risk when sentiment changes towards AI, and there's no cushion or buffer in this fund to protect you. Also, since a majority of this fund has international exposure, it also comes with geopolitical risk and other international market risks. But Robo is the pure AI play on this list of ETFs, and it's built around machines that are ultimately run and be powered by AI. And it's for those investors that believe in the future of robotics and want to be exposed in the early stages to one of the few robotic funds that are out there in the market. The sixth one on the list is AIS, the Vista Shares Artificial Intelligence Supercycle ETF. This fund targets the companies at the center of the AI build-out, like semiconductor manufacturers, hardware providers, infrastructure players, and more that are making the AI supercycle possible. And AIS is based on the BITA Vista Shares Artificial Intelligence Supercycle Index. These are companies that generate revenue from high-performance semiconductors, data centers, and building and operating AI applications. And the index also has some specific screening criteria in place, and 50% of the company's revenues must fall within the 3 themes that I mentioned earlier. It then places bucket weights for different categories based on the importance to the AI ecosystem at a given time. No stocks can make up more than 4.5% of the portfolio, and the index is reconstituted and rebalanced twice a year. And for the fees, it has an expense ratio of 0.75%, costing $75 for every $10K invested. For the portfolio, AIS is currently holding 61 stocks, and the top holdings include names that you've likely heard of, like SK Hynix, Micron, AMD, Vertiv, Intel, and others. And on the sector side, you have semiconductors and semiconductor equipment up top, then tech hardware and electronic equipment. So it leans mostly into those semiconductor and memory stocks. This is another pretty new fund that doesn't have a long track record, but since it was created in December 2024, about 1.5 years ago, it has total returns of around 208%. These are amazing returns, and it shows how aggressive the AI space and semiconductors have been moving. Unlike some of the other funds, AIS doesn't just focus on one layer of the AI ecosystem. It's diversified across different layers of the stack, giving you exposure to semiconductors, electrical equipment, hardware, software, and more. So you're positioned to benefit from the growth potential from a variety of areas. Now, the downside is that you're pretty heavily exposed to semiconductors, especially when it comes to memory. And if there's a pullback or change in sentiment, the fund is quickly going to reflect that. The fund also has a good chunk of international exposure, which accounts for about half of the portfolio. And the most obvious one is that it's less than 2 years old, so it doesn't have a long history. But compared to the others, AIS gives you some broad exposure while still being primarily focused on AI and AI infrastructure. And for those investors that believe in the future and growth potential of the AI theme, then this is a fund to consider. Alright, so there's a couple things that you have to know before putting any money into these funds. Starting off with the risk behind the rally. First of all, the stocks and funds on this list have had some crazy returns, and that's exactly why this point matters. Valuations on AI stocks have gone up a lot, and the market has priced in a lot of future expectations. Many companies are still in the early stages and are working to prove that there's meaningful ROI from these AI investments. This means that if things take much longer than expected or results fall short of expectations, then the corrections in these funds could happen pretty quickly. But it's also important to realize that the earnings growth across the AI space has been very strong, so the story isn't just built on hype. And this risk isn't that the AI thesis isn't true, but maybe the market is pricing in years of good news, leaving no room for error in the short term. Next is that these funds come with high volatility and risk. Every ETF on the list can move aggressively in either direction, up or down. If the tech sector takes a hit, then these funds are going to be 100% exposed, and you won't have any protection in the funds. And like I mentioned earlier, any bad news or bad earnings, geopolitical issues, or change in market sentiment will have a big impact. These are all highly concentrated funds within the tech sector, with IGM being the only exception just because it's a bit broad, but remember, it's still only focused on tech. You also have to keep in mind that half of these funds are still pretty new. AIPO and AIS have less than 2 years of history, while DTCR is around 6 years old or so. So not only is the history short, but they haven't experienced a variety of market cycles. And in the last few years, we've been on a serious bull run. This means we don't know how they'll hold up through other periods, and the returns that we see today are based on a massive AI run. This doesn't mean that you should avoid them, just be aware and keep that in mind. Now, if you want to see some more options on some high growth ETFs, I talk about some of the best semiconductor ETFs in this video here, or if you want to learn about some other high growth ETFs, then check out this video here. If you got some value from this video, be sure to hit that like button and subscribe. I appreciate you watching, keep on investing, and I'll see you in the next one.